Why invest in the stock market? If you are wondering if stock market investing is a smart choice for you compared to other investments like life insurance or real estate or bonds or even a savings account, then you're definitely going to want to stick around for today's video. I am Tiffany Thomas, your wealth mentor. I achieved financial freedom in my 30s and became a millionaire at age 40. I'm here to help you do that even earlier and easier. So let's dive right in. All right, if you are tired of your money sitting idle in a savings account, or if you are curious about the best ways out there to invest your money, or if you are simply looking for a very passive and flexible investment, then today's video is definitely for you. Before I dive into the advantages of investing in the stock market, I want to cover a few different investment choices. We're going to go over life insurance, even though that's not technically an investment, but we'll talk about that. And then we'll talk about real estate, and then bonds, and then savings accounts. There are two main types of life insurance. The first one is term life insurance, which I would say is good if you have other people that are depending on you for money. The second type has a lot of different names. It can be permanent life insurance, whole life insurance, indexed life insurance, variable life insurance, and whatever other names they might come up with for life insurance. But essentially, you're looking at term life insurance and then the other types of life insurance. With term life insurance, you are buying life insurance for a certain term, a certain amount of time. So it could be while your kids are young, and as they grow up, then the life insurance is going to end since they aren't going to be relying on you for money. So this is the type of life insurance I would say would be okay to get if other people are relying on you for money. Otherwise, you can honestly invest your money in the stock market, which we'll talk about later, and make more money that way than just buying term life insurance. And then the other type of life insurance, which could be a permanent life insurance policy or a indexed universal life or variable life. There's different names for it, but essentially if it's not term, then it is one of these. And life insurance salesmen are very good at selling this type of life insurance. And I know this from personal experience because I used to have one of these policies. I was talking to my 401k rep when I had my 9-to-5 job, and he recommended that I set up a whole life insurance policy. And so that's what I did. I thought he knows what he's talking about, so I set up the policy. And once I started doing more research, I realized that it is not a good investment for me or basically for pretty much anyone else. I ended up canceling that policy, losing thousands of dollars. But if I had kept that policy and canceled it even later, I would have lost even more money. So I wanted to get out as soon as I knew that was not a good investment for me. And if you have heard of Jeremy at Personal Finance Club, he did a whole post on whole life insurance. So I'm going to reference his article because it is spectacular. He actually bought the policy, read through all of the documents, and broke down everything for us. And I wish I could go through the papers that I received when I had my life insurance policy, but I was so bummed about signing up for that policy and canceling it that I got rid of all of my documents. But nonetheless, I am sure it is pretty similar to the policy he received. So let's take a look at his article. And also, if you already know you do not want life insurance, you can definitely skip to the next section on this video. Okay, he says right at the top that if you were to invest $200 per month for 40 years in a life insurance policy in a IUL, or a whole life insurance policy, you would have a balance of $320,701. But if you were to invest that same amount into the stock market in an index fund, you would have $1,779,311. That is a significant difference. Let's break down the details because they do make it sound like a really good investment. Okay, the first thing is they ignore the existence of dividends. A lot of index funds or even individual stocks will pay dividends. They'll pay you a certain amount just for owning that index fund or that stock. When they are comparing a life insurance policy to investing in the stock market, they are completely ignoring dividends. And then you can see on the chart, this is what it will look like. So it makes the insurance policy look really, really good. If they're just showing you in 2002, you got a 0.75% return on the life insurance policy versus a negative 23% return with an index fund. And you can continue to go through the years. So the 20-year average, you're making a little less with an index fund at 7.38%. And then compared to the life insurance policy, you'd be making 8.67%. But that is not all. So it makes the life insurance policy look pretty good with no downside risk and a higher return, which are both good things. But let's take a look and see what would happen if we reinvested those dividends that we would be receiving. And I'll just show you the very bottom. So if we did the life insurance policy, it would be 8.67. And then if we were to reinvest our dividends, we would end up with 9.52%. So it would actually be higher than the life insurance policy. But this is not all. And of course, he says line number 2, cherry-picked time frame. They pick the time frame that is going to benefit them the most, which makes sense. So line number 3, the fees. There are so many fees. So premium expense charge, 6%. This is immediately taken out of the premium you pay. Monthly policy fees, $12. Every single month, no matter what. And then they have a per unit charge, 59 cents per month. And then a surrender charge starts at $24.91 per unit, and it starts to drop at year 11 until it's gone after year 16. That means if you want your money back before 16 years, you have to pay another fee. So it means you can't get anything back for the first several years. And if you stop paying monthly or decide to cancel your policy, you lose everything. And then there's also an index account charge, 0.06% per month. So there are a lot of fees. Comparing that to an index fund with perhaps Vanguard or Fidelity, these fees would be 0 except for an expense ratio. And a lot of the funds that I like to invest in, for example, at Vanguard, have expense ratios around 0.04%, super low. And that is the only charge that you are paying for that index fund. And then his example, instead of paying 0.72% per year, the fee in the Vanguard 500 ETF would be 0.03%, so even lower, which is 24 times lower than the fees with the life insurance policy. And then line number 4, the cost of insurance. When insurance salesmen are pushing these life insurance products, they rarely mention the actual death benefit, which is supposed to be the point of life insurance. If you were to meet your unfortunate early demise, it would pay out. But the marketing of these policies as superior investments fails to include the erosion of investment value. And the death benefit is real, but you will continue to pay this monthly cost. It never goes away, even if you don't have a need for life insurance. For example, when your dependents are self-sufficient or your investments have grown to a level where additional insurance is unnecessary, you still pay these fees. So it's based on gender and a few other factors. But for his case, at age 20, he's paying $7.08, and age 70, $116.67. And this is for an insurance benefit of $100,000. In addition to all of the fees above, your cash value will also have these amounts taken out each month to cover the cost of insurance, which leads us to lie number 5, the big lie. The cash value in the IUL policy will outperform an investment in an index fund. All right, so he breaks this down for us. So he combines the above issues, all of those fees that we're paying, and where the money is going. So for his, the premium was flexible, but it was initially set at $200. So let's see where that $200 goes. $12 premium expense charge, $12 monthly fee policy, $59 per unit charge, $4.50 cost of insurance. So total fees are $87.50. Of that $200 you put into this policy, $87.50 is going toward fees immediately. That's an instant negative 44% return on our investment. The remaining $112 goes into the cash value, which will underperform the market as described earlier. And of course, you can't actually get that money back due to the surrender fee for several years, like was mentioned before. Insurance salespeople love to talk about how the fees decrease over time. Let's look at making a $200 premium payment in the 40th year of this policy. $12 premium expense charge, $12 monthly policy fee, $59 per unit charge, $104 cost of insurance. This is assuming 69-year-old male, non-smoker. And then $192 index account charge. Total fee is $379. How is it possible they're charging $379 of fees on a $200 payment? Well, let's now dig into the cash value. So if we took a look at these fees and the below market returns, here is a side by side. You can see the returns for an index fund, the S&P 500, and then for our life insurance policy, you can see the cash out value for the life insurance policy and then invested in an index fund. So at age 30, we have zero cash out value and we already have $2,916 that we've made in the stock market. And if we continue to go down and down and down, age 69, we have $320,701 for that life insurance policy, like we talked about before. And then actually investing in the stock market in an index fund gives us $1,797,311. It is just crazy how they are manipulating the data to make it seem like investing in an index fund is not going to outperform investing in a life insurance policy. And then let's move to another point that he talks about. IULs have amazing tax benefits. This is a huge selling point for those that are selling life insurance. And there is a small amount of truth in this. There is a tax benefit to life insurance. The death benefit is paid to your beneficiaries tax-free. And he says, but that is a red herring because for almost everybody that simply doesn't matter. The current estate tax exemption is $12.06 million for a single person, and then it is $22.12 million for a couple, which means the first $12 million you leave to your heirs is 100% tax-free. And then he breaks it down in the chart. So you can actually see with a traditional IRA, 401k, no tax owed for the money you contribute, and then no tax owed as the investment grows. But when you actually sell that investment, you do owe taxes. When you die, transfers tax-free, beneficiaries do pay income tax on withdrawals. But if you are looking at a Roth IRA or a Roth 401k, you pay taxes when you contribute your money, and then it grows tax-free, and when you sell, there is no tax. And then there's no tax owed on the amount under $12.06 million per person. And then looking at a taxable brokerage account, the money that you contribute, you will pay taxes on that. That's just your normal income tax rate. You will owe tax on any distributions. With the capital gains tax rate, that can be zero on up to a certain amount of money. And I do break this down in another video, so I will leave a link to that above. You can check it out later on. But you are just paying tax on the gains that are owed. So not all of the money that you are taking out. So you're not getting double taxed. And then when you die, there's no tax owed on the amount under $12.06 million. Now let's take a look at that insurance policy. You still pay income tax on the money that you are putting in. And then as it grows, no tax owed. But by law, the value is limited and the cost of insurance ramps up, as we saw earlier. And then when you sell, you will pay capital gains tax on just the gains. And then the beneficiary receives the death benefit tax-free. The cash value is lost. In all honesty, the tax benefit of an insurance policy is strictly worse than any type of tax-advantaged account. And then just to give a quick summary, the tax benefits of a tax-advantaged retirement account like an IRA or 401k are always strictly better than the tax benefits of an insurance policy. It's a terrible tax decision to buy an insurance policy rather than max out your tax-advantaged retirement accounts. If they are all maxed out, it's still much better to pay the tax on the growth in a regular taxable brokerage account than to put it in a life insurance policy. And then lie number 7 he talks about is banks own life insurance and so should you. Essentially, we are not like banks. We do not have that much money, so why would we want to do something that a bank is doing? That doesn't really make sense. And then lie number 8, rich people do this and so should you. And Jeremy says, I'm a multimillionaire and I don't invest in life insurance. He knows lots of other millionaires too, and none of them invest in life insurance. And I am also a millionaire and I do not invest in life insurance. And then lie number 9, infinite banking, be your own bank. A lot of insurance salesmen will talk about this benefit as well. Essentially, you put your money into a life insurance policy and the cash value grows. Then when you want the money, instead of just having it and spending it, you borrow it from the policy for a fee, of course, 2 to 3% per year on his policy. And then you pay it back with interest over time. That allows the cash value to continue growing uninterrupted while you use the money. Your cash value has been eaten up by fees, so borrowing against what you have left is way worse than simply having more money and using it. And then he gives an example here. Look at age 45 in the table above. The life insurance policy has a $42,000 cash value. The index funds are already worth $202,000, a significant amount more. The infinite banking pitch says you can borrow $42,000 for a down payment on a house, while the cash value still grows as though it had $42,000. But imagine you had $202,000 in index funds. You could pull out the $42,000 and buy the house. The remainder is still worth and growing at the rate of an $160,000 investment. And you never have to pay the money back because it's your actual money, not a loan from the cash value of an insurance policy. And to go along with this, if you do have your money in a taxable brokerage account, which we found out is still better than having life insurance, you can actually borrow against your investments inside of your taxable brokerage account. And depending on which brokerage firm you are with, like IBKR, they have a really low interest rate when you borrow against your own investments. It's called a margin loan. And I have another video on that. I'll leave a link above. You can check it out later on. But that's just another benefit of having your money invested in the stock market. He says, I can imagine an insurance salesman reading this and screaming, you're doing it wrong. It needs to be this or this. The death benefit should be minimized. And he said the insurance policy is 91 pages long. It's about ½ inch thick. Inside those pages is a web of rules and numbers written by the insurance company to benefit the insurance company. This is how life insurance policies are set up. And my personal investing strategy is to invest in things that I can understand. If I have to go through an entire 91-page book on trying to understand what I'm investing in, I'm not going to invest in it. I've already learned from my previous mistakes. And then he gives just a few more bonus lies here. Here are these bonuses. To take out money, there's a $25 withdrawal fee. Can you imagine if your bank or brokerage charged that every time you wanted to withdraw money? And then quoting from his policy, we may delay paying you. It's up to them when they decide to pay you. It may take up to 6 months after they receive your request. And then they can change the fees whenever they want to. And they can also change the caps whenever they want to. And then when you die, your beneficiaries get the death benefit and your cash value stays with the insurance company. He gives another example. If the death benefit is $100,000 and the cash value is $300,000, your beneficiaries receive $100,000. If you did the unlimited banking thing and borrowed $100,000 against that $300,000, then the death benefit is used to pay back that loan, which the insurance company keeps, and your beneficiaries get nothing. He also talks about term life insurance, like I mentioned before. So if someone does depend on you, you can buy term life insurance. It's dramatically cheaper and you're only paying for the cost of the insurance. And then you can invest the difference in the premium. By the time the term is up, your investments will have grown to more than the whole life insurance policy death benefit, and you'll be way ahead. Okay, so that is the breakdown on life insurance. Hopefully that made sense and you can see how insurance salespeople will manipulate the charts that they have and not really tell you about all of the different fees that are there. If we really break down those numbers like Jeremy did, then we can see it is actually better to invest in the stock market. Okay, let's move to the second investment, which is real estate. And I actually really like investing in real estate. But I know that a lot of people are not interested in real estate because it is not completely passive like the stock market is. I have to deal with tenants and any fixes that I need to do at any of the properties. It is not completely passive like the stock market. It's also not as liquid as stock market investing. If you wanted to sell your property, you have to get it ready to sell, you have to put up the for sale sign, you have to show the property, and usually work with an agent. So you can't just instantly sell your property and put your money somewhere else, but you can with the stock market. And then the third type of investment is bonds. And they are essentially loans made to the government or to corporations, and then you get paid a certain interest rate for a specified period of time. And bonds are definitely considered safer than stocks, but they're also not providing a higher return. Stocks are going to give you a lot higher return than bonds will. So depending on if you want to grow your wealth, then we want to be investing in the stocks. And if we want to just preserve our wealth, then that's where bonds come in. And then the next one is investing in a savings account. While this is very safe because you get a certain interest rate and your money isn't going to drop, it's also not going to give you as high of a return if you were investing in the stock market. For example, I do have my savings at Ally, A-L-L-Y, and they are offering a pretty good interest rate on their savings account. It's at 4% right now. But you would be making around 10% if you were investing in the stock market. That is a significant difference, especially over the long term. And then just a quick mention, if you are thinking about gold, I have another video about investing in gold. I'll leave a link to that above. You can check it out later on. And just to give you a quick performance overview of these different investments, I'm going back to Jeremy's website because he has this cool graph on there and it shows why stocks are the best. And he says, if you invested $1 in 1928, here's how much it would be worth today based on what you invested in. You can see from this chart, the highest is stocks. And then you can see where bonds are, you can see gold and real estate. And to be fair, this real estate is just the appreciation, so it's not including the rental income that you would be receiving from real estate. All right, now that we've covered the alternatives to investing in stocks or in the stock market, let's talk about the benefits of investing in the stock market. Why invest in the stock market? First and foremost is the potential for that long-term growth. We can definitely see our investments rise over the long term if we are investing in the stock market. I know this has been true for me personally. I've seen anywhere from a 12% return to over 100% return. And yes, it is risky and it's very volatile in the short term. That's why it's important that we keep a long-term perspective, because we know over the long term, as long as we are choosing good investments in the stock market, our investments are going to grow exponentially. And then the second reason is for liquidity and flexibility. If we want to sell our stock market investment, we can do that very quickly. It's very liquid, making it a very flexible investment. If we want to get our money invested in the stock market, we can do that very quickly by setting up an account and selecting our investment and getting it invested. And then for me, when I wanted to pull out some of my stock market investments and actually put it in real estate, put it toward a down payment on a property, I was able to do that very quickly. I was in the process of purchasing a home and I was able to sell my investments and have that in my checking account ready to pay for the down payment. And then the third benefit of investing in the stock market is diversification. It's very easy to diversify. You don't have to just buy one company or one stock. You can buy a whole bunch of stocks inside of just one index fund, or you can even buy multiple index funds. So the diversification is very simple to do in the stock market. And that way it reduces our risk when we are investing. If we just had one single investment, for example, if I just had one single real estate property and I wasn't able to get tenants, then I'm not receiving cash flow. But when we are investing in the stock market, if one of those companies that we are invested in inside of an index fund, if they go bankrupt, it's not really going to affect my investment because there's so many other companies inside of that one index fund. And then the fourth reason on why to invest in the stock market is because of dividends and passive income. Like I mentioned before, you can invest in an index fund or even an individual stock and receive a dividend, which means you are just receiving money for owning that stock or that investment. And even if some of those investments don't pay a dividend, you can still take out some of that money at any point. Once you want to start living off of your stock market investments, you can start creating that passive income by just selling a little bit of your investments over time. And then the fifth reason to invest in the stock market is accessibility. You can invest a very small amount and get started in the stock market. You can't really do that with real estate. While you can take out a mortgage, the down payment is going to be thousands of dollars. But with a stock market investment, you can honestly start with $5, making it very accessible to anyone. And if investing in the stock market does sound like something you want to do and you want my help with that, I have a free masterclass. I will leave a link below in the description. You can click on that link and check out the free masterclass on how I can help you invest in the stock market. Comment below and tell me if you are going to invest in the stock market. And if you found this video helpful, please hit that like button and share it with someone else who would like to hear this information, and hit the subscribe button to subscribe to my YouTube channel and hit the little bell to get notified on when I post new videos. And if you want to see even more awesome content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.